Reserve is, what monetary policy meant, what does it mean to, set interest rates. All that kind of stuff was, quite honestly, a black box to me. And it is probably a black box to most Americans, and it's probably somewhat of a black box to most of you. And so, yeah, so that's what we're going to talk about here this morning. So remember that our agenda here for today is we're going to talk about money in the Federal Reserve, Chapter 14 this morning. This afternoon, we will maybe finish up Chapter 14, depending how far we get this morning, and then we will take your quiz, right? Quiz number 4. Quiz number 4 is going to be on aggregate demand, aggregate supply model, which is Chapter 12. That's going to be on fiscal policy, Chapter 13. Okay. So anybody have any questions about where we're headed here today? Okay, well then let's jump right in and let's begin talking about money. What better thing to talk about than money? All right, so Chapter 14, we are making progress in this book. Okay, money and the Federal Reserve. Okay, well, right off the bat, we got to be clear about what do we mean by money. Sorry, my door keeps on blowing open. Well, that lasted for all of 2 seconds. There. Okay. All right. So what is money? So once again, here's one of these words that economists use in a much more specific and definite way than we typically use in everyday life, right? So in everyday life, when we talk about money, we could be talking about any number of things. You could be talking about income, like that person made a lot of money last year. We could be talking about wealth, like Zach's got a ton of money, right, in Dogecoin. But that's not exactly what economists mean by money, all right? What do economists mean by money, right, from our readings? Who can help me out with this? What do economists mean when we talk about money?
It's like anything that can be used to purchase like a good
Yes.
or a service.
Right. Anything that can be used to purchase a good or a service, right? Or typically how we say it is, it's really anything that is generally accepted in trade, which is really just another way of saying what you said, Gabe. Anything that is generally accepted in trade. And what this means is that money is typically what we measure prices in. Right? Price of a latte is $5, right? Assuming US dollars, right? So that's how we measure prices, right? In something that is generally accepted in trade. So right off the bat, don't fall into the trap of confusing money with income or money with wealth, because they are not the same things. You can have an income and have no money, right? Or you can have some money but no income, right? So these are different things, right? Anything that is generally accepted in trade. Now, one of the things that we've observed throughout human history is that almost always something serves the form of money within an economy. There have been barter economies in history, and barter economy is really an economy without money. In other words, an economy in which you trade goods for goods. However, barter economies almost never last for a couple of reasons. First off, you have to have an extremely simple economy for barter economies to work, right? It has to be very simple. Once it starts to get more complex, the difficulty of trading goods for goods becomes astronomical. And this is the problem of the double coincidence of wants. The problem with a barter economy is you have to have what they want and they have to want what you have. So Sunny says, well, technically, Iranian and Venezuelan economies are sort of barter economies. They trade oil for goods to circumvent U.S. financial transactions. Yes, I mean, I see your point. I don't completely disagree with you. I would say, though, that one of the things here about our definition of money is it has to be generally accepted, right? It has to be generally accepted. So the fact that Iran and Venezuela have kind of worked out some deals with certain people to get goods and services for oil. I mean, I'm not convinced that that makes oil money because it's not generally accepted. So, think how difficult the barter economy would be in a modern economy, right? Let's say that you had a goat and you wanted a sweater, right? So how difficult would it be for you to take your goat to the mall and buy a sweater? It would be pretty difficult, in part because not only do you have to find a sweater you want, but the person who has the sweater you want also has to want your goat, right? You need to have that double coincidence of wants. And that makes trade in a barter economy very difficult. And so if you think about what money allows us to do, is it allows us to break this into two transactions, which is simpler. I can sell my goat for money, take the money to the mall, buy a sweater. As a result, in every economy, almost every economy, I should say, something begins to serve the form of money, right? Something begins to serve the form of money. So if you look throughout history, we've seen lots of unusual things serve as money. Shells have served as money. Gold, of course, has served as money. Rocks have served as money. If you look today in places like prisons, we've seen different things that have served as money. Traditionally, what served as money in a prison? Cigarettes, right? Nowadays, most prisoners cannot smoke in prison, so what serves as money? Strangely enough, canned mackerel serves as money in most prisons. You might say, what in the world, canned mackerel? Well, most prisoners, the prison diet is not very protein heavy, and most prisoners spend a lot of time, lifting weights. They want to eat a lot of protein. And so as a result, canned mackerel is a very common good to have in prisons. And so this began to serve as money, where people who want to trade goods or services trade them for canned mackerel, which illustrates that, really anything in practice can serve as money. The key, though, is it has to be generally accepted. Why is money so popular, right? Well, really, money serves three functions. There's three reasons why money is so ubiquitous. The first is, I think, maybe the function that we've already hit on, that money is a medium of exchange. It makes trade easier. By allowing you to break that one difficult trade because of the double coincidence of wants into two simpler trades. But there's a couple of other very valuable functions of money. Money is also a unit of account. It's a way to measure value. Money is in its own way, shape, and form a language, right? So if I tell you that my car is worth 13 goats, what does that mean to you? It means nothing to me. If I tell you my car's worth $1,200, what does that mean to you? Yeah, it means I got a shitty car, right? You know that immediately. Yeah, we have a good idea about what the value of money is, and as a result, it's a very efficient way of conveying value, right? Finally, money has to be a store of value. In other words, money has to be a way of savings. This is the reason why, in general, fish has not been effective money, right? Is because it's not a very good store of value. On the flip side, things like gold, have been and more commonly used as money because gold doesn't deteriorate in the same way that a fish would, right? So one of the interesting things that we have observed throughout human history is that something always takes the form of money because these three functions are so needed within any economy, right? Even in the Soviet system, right? The Soviets wanted to abolish money because they viewed money as the ultimate capitalist tool. But the problem was, without something serving as money, they had no way to account for anything that they did. They had no way to account for production. They had no way to account for trade. And so even the communists, right, had to have the ruble. They needed something that served as a form of money. And so it just goes to show you that, if humans are going to trade, something is going to need to serve the form of money because these three functions are very, very valuable. Now, throughout history, we have seen many different types of money. The first and the most traditional forms of money is what we call commodity money. So commodity money is money with inherent value. And what I really mean by this is commodity money has value outside of the fact that it's money. Right? So things like gold or cigarettes or canned mackerel. Right? These are commodity monies because you can use them as money, but if you don't want to use it as money, you can just consume it. And so the first forms of money almost certainly were different forms of commodity money, right? They were goods that people were trading, and they were being traded so often that eventually this good kind of became money, right? Became the generally accepted way that you would make a trade. Now, commodity money, you can see the appeal of commodity money, right? That it's kind of nice that it has some intrinsic value, but there's a problem with commodity money. And this problem is referred to as Gresham's law, which is maybe you've heard this phrase bounced around. This is an idea that occasionally you'll see out in the media or people talk about Gresham's law. Gresham's law is a pretty simple law. Bad money drives out good money. In other words, what's going to happen to the quality of your money over time if you have commodity money? It's going to get worse and worse and worse and worse. Okay? Why? Well, let's think about a couple of examples. One example is what happened in prisoner of war camps during World War II, right? So in prisoner of war camps, many soldiers were there. They had rations. And of course, not every soldier wanted the same, ratio of rations as every other soldier. And so they would trade their rations. And what began to serve as money in these prisoner of war camps were cigarettes, right? They became to serve as money. However, what happened to the quality of cigarettes that got traded over time? They got worse and worse and worse. Why? Well, because you would keep the good ones and smoke them for yourself, right? The better brands you'd smoke, the worst brand you would trade. Or people would open up the cigarettes and take out a little bit of cigarette tobacco and re-roll them and turn 10 cigarettes into 15 cigarettes, right? So you would get worse and worse cigarettes over time. The quality of your money would diminish. This is a consistent problem with any form of commodity money, even if you're talking about gold coins, right? If you've ever been to, for instance, the Natural History Museum in Chicago, they have this beautiful display of gold coins there from the Romans and the Greeks. One of the interesting things is many historians can actually tell how old a coin was by how big it was. Why? Because what would happen when people would get these gold coins in trade? They would take a knife and they'd scrape the edge and take a little bit of shavings off the coin every time that it passed people's hands. And so what happened to coins over time? The more that they fluctuated, the more that they traded in society, the smaller and smaller they would get, right? That's Gresham's law. And here's a little factoid that you can impress your roommates and friends with. You ever wonder why a quarter has serrated edges on it, but a penny and a nickel doesn't? It's that reason, right? That quarters used to be made out of silver. So to see if anybody had shaved the edges, they put those serrations on them. Nowadays, quarters are not made of silver, and nobody in their right mind would, try to shave the edges of a quarter. But yeah, that was a real thing. Those serrations are really an example of Gresham's law. And so commodity money had this huge problem in that it would just get worse quality over time. People would take gold coins and they'd melt them down and put them in, put lesser quality metals and then remint them. And this just happened all the time. It was a problem. The other problem with commodity money, so we'll call that problem number one. The second problem with commodity money is it's often very bulky. Right, there's big transaction costs with it. So you think about, gold coins, it's heavy, right? A significant amount of gold coins is very, very heavy. It's hard to transport that. So you have these two problems with commodity money. So what began to happen over time? Well, over time, we moved to a different form of money in response to these two problems. More developed and larger economies began to move to what we call banknotes. And eventually this became the gold standard. Right. A banknote is really how the first banks operated, where if you had some gold, you could deposit the gold in the bank. And what would the bank give you? It would give you essentially an IOU, a banknote. And then you could trade these banknotes instead of actually trading the gold. All right. These are essentially a first form of paper money. Right? In early US history, we had our own version of this. We called them greenbacks. This was paper currency printed by individual banks. So banks would take deposits and then they would print this paper currency, which basically represented a claim to a certain amount of gold. It wasn't, believe it or not, until 1873 that the US had a national currency. In which the federal government basically regulated currency. Under the gold standard. And how a gold standard worked was simply a certain amount of gold backed each piece of paper. So these pieces of paper actually represented claims to a certain amount of gold that was held at a national bank. And so why did bigger economies move to the gold standard? Well, once again, if we go back, it's to really try to overcome these two problems associated with commodity money. The first problem is Gresham's law, that it was hard to regulate gold coins. As Faith mentions in the chat, it was very common for gold coins to be melted with other metals to artificially increase their weight. And so that's a common problem, right? A very common problem throughout history of trying to regulate gold coinage. And so instead of doing that, right, what you did is you put your gold in a place where it's safe and could be protected, and you trade the pieces of paper, which, first off, you don't have to worry so much about Gresham's law, and second off, trading pieces of paper is a lot less bulky and a lot easier, right? And so eventually governments got involved in this, right? And so it just wasn't left to individual banks to do this, but governments themselves got involved in making sure that the paper currency was consistent across states and regions, and that when a piece of paper was issued, that it was backed by a certain amount of gold. Are we still on the gold standard? No, we're not on the gold standard. What are we on today? The system of money that we have today is fiat money. Fiat money, fiat basically meaning king's decree. Where does fiat money get its value? Well, to say that it's king's decree is not really right? It's not that the king has declared its value. Where does paper money today get its value? From the fact that we think it has value, right? So fiat money is money whose value comes from the fact that people believe it has value. Money whose value comes from the fact that people believe it has value. It is a belief system. Or, as many economists have talked about it, it is essentially a measure of societal trust. We trust that money has value. Why do I take US dollars in my paycheck? Because I'm pretty sure that somebody else will take those US dollars at a store, right? It's a shared belief system. But there is no intrinsic value to this money. If you take it to a Federal Reserve Bank, if you take a US dollar to a Federal Reserve Bank and you give it to them and say, give me some gold, they will say, ha, and laugh in your face, right? If you give them a dollar bill, what are they going to give you back? Another dollar bill, right? Maybe they'll give you a newer one, but it's not going to be different, right? It is paper money, right? And it is really, in this sense, a system of organized trust. We accept that it has value because we trust that other people think that it has value. Now, you might think, how in the world did we move to this kind of system? And yeah, it's a little strange when you think about it. I mean, some people find this very disconcerting, that their money has no real intrinsic value. In fact, for those of you who are familiar with The Onion, which is a satirical newspaper, they had an article a few months ago that said the US economy grinds to a halt when Chairman of the Fed lets slip that money is a socially, what was it, a shared belief system, right? Yeah, it's a little disconcerting, right? And so how in the world did we move to this fiat money system from the gold standard? Well, to kind of illustrate how we moved to gold standard, I want to talk about a place called Yap. Okay. What in the world is Yap? Yap is an island in the Pacific. And so Yap is an interesting place. I've never been there. But one of the interesting things about Yap is that it has these big stone wheels on it. I'm going to show you a picture of what these stone wheels look like. If any of you have actually ever been to, for instance, the Natural History Museum, the Smithsonian, they have one of these pictures. But here you can see these stone wheels that are on the island of Yap, right? And these things are pretty big, right? Some big stone wheels. Right? So strangely enough, people on Yap view these as a source of wealth. If you own one of these wheels or many of these wheels, you are a wealthy person. And because these stone wheels were viewed as a source of wealth, they also became a source of money, in the sense that people, when they wanted to buy things from each other, would actually trade these stone wheels. Okay? So they were a form of commodity money in some sense, right? That people are trading these stone wheels. Now, as you can imagine, what's the problem with trading stone wheels? Not very easy to do, right? I mean, those things are heavy. And so what did people on the island of Yap do? Well, instead of actually trading the stone wheels, what they did is they traded IOUs amongst themselves. They essentially moved to paper currency that were backed by stone wheels. So the pieces of paper would trade or move around, and the stone wheels would stay in the same place. Of course, what happened over time? Over time, these stone wheels, kind of deteriorated, many of them. There is a story of one guy who was using his stone wheel as an anchor and his boat sank. So what happened to the value of that piece of paper that was issued to that stone wheel? When that stone wheel went to the bottom of the ocean, did that piece of paper go down in value? Well, the question was, were people going to go get those stone wheels anyway? Like, does it really matter to people if the stone wheel is in somebody's backyard or at the bottom of the ocean? You weren't going to go get it anyway, right? As long as you're pretty sure that somebody else will accept that piece of paper, you will accept that piece of paper. And so Yap gradually moved from a stone wheel standard to a more pure fiat money system. And it was just simply a question of accepting a belief. As long as they accepted the belief that these pieces of paper had value, then they did have value, right? And that's essentially where we are with our current system, right? Who controls the amount of money in our current system? As we're going to talk about, it is a central bank. A central bank can set the amount of money irregardless of how much gold they have, right? So Sonny asked in the chat, could you highlight how gold reserves of a country impact the monetary value of its currency? No impact. No impact, right? There are no, I guess I shouldn't say that. I don't know if there's any countries in the world that are on somewhat of a gold standard, but to my knowledge, no. And so the gold reserves have no impact on what a country's money supply is. It doesn't matter. Sonny says he's moving the Yap. I'm with you, Sonny. Right? Let's go buy a stone wheel and live it out. It looks like a pretty nice place to me. So yeah, what happened in Yap was really not that much different than what happened in most modern economies, right? The gold was sitting in a bank somewhere and we were trading these pieces of paper. But did people really take the pieces of paper and go take them to the bank and pull gold out? No, as a practical matter, people never did that. And so eventually when the link was broken between paper money and gold, as long as people still had basic sense of trust in the paper system, that was fine by them, right? As long as they were sure that somebody else, right? Somebody else was going to take this money, then they were willing to take this money, right? It's a belief system. And, as I said, that's a little unsettling to some people, but listen, let me explain it this way if that's unsettling to you. The belief that gold has value is a belief system, okay? Gold is just yellow rocks. Why should yellow rocks have more value than pieces of paper, right? Everything that we believe has value is based on a belief system, right? So the fact that we transferred our belief in value from gold rocks to pieces of paper, whatever, it's still a belief system, right? It's still a belief system. So, if that helps you sleep tonight, think about it that way, right? Now, so that's what money is, at least in theory. That's kind of the big picture, thinking about money. Now, we're more interested in kind of the real life, real world implications of money, and particularly, what exactly do we count as money in a modern economy? We don't have any stone wheels, right? So what exactly is money in a modern economy? And what counts as money? Is currency money? Yeah. Is checking account money? How about that mutual fund account you have? Is that money? Money in the stock market or holdings in the stock market, is that money? Is Dogecoin money? Right? um, so let's be clear here. This is there's not a clear definition about what money is, right? To some extent, we have to make we have to draw arbitrary lines as to what we're going to consider to be money and what we're not going to consider to be money. And so what are the arbitrary lines that economists typically draw? Well, economists typically use two definitions of money. And because they're economists, they really came up with very clever names for these definitions, M1 and M2. M1. M1 is things that is clearly money. M1 is currency and demand deposits. So these are the things that are clearly money. They're clearly can be used to purchase goods and services. So paper currency, yes, and coins, of course, is part of this. And then demand deposits. What are demand deposits? These are basically any sort of bank deposits in which you can pull money out on demand. Okay, so for the most part, most checking accounts would count as demand deposits, right? Any account that you put money in and you can pull the money out on demand would be what economists consider demand deposits. What's M2 then? M2 is everything in M1 plus some things that are very close to being in M1. Savings deposits at banks. Small certificates of deposits. I don't know if any of you have a certificate of deposit at a bank, but it's essentially a savings account. There's some technical differences between the two, including how long you have to keep your money in it without paying a penalty, but it's essentially another form of a savings account. Same for what we call money market mutual fund accounts. These are savings accounts that you hold at banks in which they hold the money in very short-term bonds. The key to these things, though, is that they're very liquid. They're very easy to turn into M1. And so you got to think about M2 as like M1 and things that are very easy to turn into M1. Okay? So if you look, if you want to just get some relative size as to M1 and M2, I think this is data from 2019, so I'm sure it's a little bit different, but this gives you a rough breakdown. The left-hand side pie is just M1, and you can see currency in circulation is about $1.7 trillion. And checkable bank deposits is about $2.5 trillion. Okay, so about 2/3 bank deposits, 1/3 currency. And then if you look at M2, M2 is a lot bigger than M1, right? And why? Because really savings deposits. Savings deposits are a really, really big part of M2. What's the difference between a savings deposit and a checkable deposit? Well, most of us may not realize this. The thing with the savings deposit is you actually do not have the right to immediately withdraw your money from the savings account. okay? Banks can typically ask you to wait up to 5 business days to pull your money out of a savings account. Now, as college students, if you went to your local bank and said, give me all my money out of my savings account, they'd say, here's your $50, get the hell out of here, right? But if you had $1 million in a savings account and you said, I want my money, the bank would be within its right to say, come back in 5 days and we'll give you your money, right? And so that's why, these things in M2, like time deposits or certificates of deposit and savings deposits and money market mutual funds, they're a lot like M1, but they're not exactly. Why aren't credit cards included in money? Don't we pay for things with credit cards? Why don't we include credit card balances as money?
Yeah, but isn't it like just a way of accessing? I guess that would be a debit card, but I mean, you're going to pay for it. Yeah, like Brenna said.
Yeah. Right. So yeah, if you didn't realize this, when you pay for something with your credit card, you don't actually pay for it. You still, at the end of the month, have to pay your balance on the credit card, which is linked to a bank account, most likely. So yeah, credit cards are not a means of payment. They're a means of deferring payment, which I really hope that is not new news to any of you, right? Or you're going to have a very rude awakening at the end of the month. So listen, credit cards have played a big role in changing around M1 and M2 because people hold less money now than they used to, right? I hate to admit this, but last Friday, I actually dropped my wallet. I went into Bruegger's to get some bagels and I had like 50 things in my hand and I dropped my wallet, and about like 20 minutes later, I was like, oh my God, I must have dropped my wallet when I went into Bruegger's. And I wasn't worried about it really, because what did I have in my wallet? I had no currency, right? I had like a credit card and an ATM card. That was it. The way that we pay for things have changed a lot, particularly during this pandemic. And that is definitely changing the mix of M1 and M2, right? I mean, M1 and M2 are changing because of electronic payments, but electronic payments are not included in M1 and M2. What about Dogecoin or Bitcoin? Why aren't these in here? Should they be in here? What do you think?
Is it kind of like you're not putting money in a savings account, but more like investing it in like a house or like something? It's not like, it's more like an investment, not like a savings account, I guess.
No, I mean, to me, no. I think it is more savings than investment. But regardless of whether it's savings or investment, the question is it money? So think about our definition of
You
money.
can pay for stuff with Bitcoin and stuff. So I think we're slowly transitioning to that. But I don't think currently, like, it's definitely not as liquid as the dollar.
Yeah.
Like you can't pay for as many goods and stuff as a dollar, but.
Right. Yeah, I think I would agree. Remember, the key to that money definition is it has to be generally accepted in trade. So while it is true that, Bitcoin is becoming more accepted, I would not call it generally accepted. But I do think this is something that economists are going to have to think about over time, is whether, at what point do we include things like Bitcoin or Dogecoin or whatever forms of electronic money get included. How about Venmo? Is Venmo money? Well, once again, not yet, because right now most Venmo accounts are linked to a bank account. So Venmo is much more like a credit card than it is money, because when you pay somebody with Venmo, then it's linked to a bank account through which it clears. But you'll notice that you can maintain balances in Venmo, right? And you can trade those balances. Venmo, to some extent, is creating electronic money. And to the extent that Venmo would create more electronic money, which is one of the things that is happening in other countries, right? The US is actually relatively slow in this movement towards creating truly electronic money. In China, it's much more common, right? Here in the US, credit cards and bank accounts are much more commonly used. But in other countries where people don't have credit cards or bank accounts, they're just they have apps that are creating electronic money, that are creating balances that get traded between people. And in those countries, yeah, you know, some of these electronic monies are really reaching the point of being generally accepted. You know, when I was in China right before the pandemic, which would now been like a year and a half ago, I mean, I was just simply amazed at the amount of electronic purchases. I mean, really, the only people that were using actual paper money were stupid tourists like me, right? Everybody else, for everything, was using their phones to pay. You know, every place had a QR code. And when I say every place, I mean even like street vendors have QR codes, and you'd walk up and you'd click your phone, take a picture, they give you some food, right? I mean, the actual use of physical money was extremely rare, right? And it, as I said, it was only really kind of like tourists, like me and other students who really didn't have these accounts ready, that were using real money, right? For the most part, people were using electronic money. So yeah, we would expect this world to be a much different world in a few years, right? This is a part of economics that is changing quite dramatically, right? Quite drastically. And so we'll see where we are in a couple of years. All right. You know what? Let's take an early break. We usually don't take breaks this early, but this is a good place to stop. I don't know why. So yeah, what the hell? Let's take an early break and let's meet back here maybe at about 9:56, okay? All right, talk to you in 5 minutes. Hey, everybody. Okay, so let's talk about banks now, because as we talked about before break, by the way, from this point onward, when I talk about the money supply, I'm going to be talking about M1, okay? So just to be clear, when I say money, unless I say clearly otherwise, I'm talking about M1. So we know that money is currency plus demand.
I can't see your screen.
Okay. Okay. So we know that money is currency plus demand deposits. Well, who controls currency? As we're going to see, that's largely the Federal Reserve. Who controls demand deposits? Well, banks. Banks play a big role in what the money supply is. So for us to really understand the money supply and monetary policy, we really need to understand banks, okay? What do banks do? Well, banks do a lot of things, but at the highest level, banks take deposits and they make loans and they hold treasury assets. That's the main things that banks do. So the easiest way to kind of see how a bank works is to look at a bank balance sheet. Hopefully balance sheets are something you're all familiar with, either whether you've taken ECB 151 financial accounting, or hopefully this is a concept that you were somewhat exposed to in high school, right? But you can think about any business as basically having assets and liabilities, right? Assets being the uses of funds, and liabilities being the sources of funds. So how do banks raise money? What's their liabilities? Well, they take in deposits. That's one way they raise money. And then they also do other forms of borrowings, such as they issue bonds. And then finally, they have equity or bank capital, meaning investors, either stocks or personal investors that contribute money. And these are essentially the owners of the bank, the money that they've put into it. These are the three main ways that banks raise money. And then what do they do with these? They hold reserves, meaning they hold kind of liquid, very liquid assets, like cash. They make loans. And they hold treasury bills or government bonds. These tend to be the main assets that a bank holds. So at the very highest level, right, in reality, and of course, banks do raise money in a number of different ways, and they have a number of different assets. But at the highest level, this is really what banks do. They raise money through deposits and borrowing and equity. And what do they do with that money? They hold some reserves, they make loans, and they hold some government bonds, right? And of course, they want the things on the left-hand side of this to earn a higher return than things cost them on the right-hand side, right? So the cost of their liabilities, if that's less than the return they get from their assets, they make money, okay? That's basically how banks work, right, in a nutshell. Now, for our purposes, let's think about how banks have to handle their deposits. When a bank gets a deposit, can they lend all of that money out? No. Instead, banks are subject to what's called a required reserve ratio. Okay, a required reserve ratio is the percent of deposits that cannot be lent out and must be held on reserve. At the Fed. So whenever a bank takes in a deposit, a percent of that they cannot lend out, but instead they have to keep that on reserve at the Fed. So think about it this way. A bank's required reserves, right, which your book calls, I'm trying to use the same notation. A bank's required reserves is equal to the required reserve ratio times the amount of deposits. So whatever this required reserve ratio is, you have to multiply that by the amount of deposits to get the amount of required reserves that the bank has to hold. And then also it's important to understand though that banks can hold more than required reserves. Banks actually hold total reserves. A bank's total reserves are the amount that they have to hold as required reserves, and then any amount over and above that. Of their total reserves, what's the amount that a bank can actually lend out? Banks can only lend out their amount of excess reserves. That's the amount of new loans that a bank is ready to make. They can only lend out excess reserves. They cannot lend out their total reserves because some of those total reserves they have to keep as required reserves. Okay? So let's just kind of make sure that we understand this. Let's think of a little example here. So here we have Bank One, and they have, here's their balance sheet. They have 10 million in deposits and 1 million in other borrowings and 1 million in equity. That's how they've raised money. And in their assets, they have 3 million in total reserves, 9 million in, whoa. Sorry. My example was not going to work out. $8 million in loans and 1 million in T-bills. Okay. What's the amount of new loans that this bank could make? Well, we know that total reserves is equal to required reserves plus excess reserves. And what are required reserves? The required reserve ratio times deposits. And for our example, let's assume that the required reserve ratio is 10%. Okay, 10%. So 10% of deposits a bank has to keep as required reserves. So in this example, what's required reserves?
1 million.
Right. 10% times the amount of deposits, $1 million is the amount of required reserves this bank has to hold. Then what is the amount of excess reserves this bank has? Total reserves minus required reserves, $2 million. That's the amount of new loans that this bank could make, up to $2 million. The most commonly made mistake here is to notice this, that required reserves are a percent of deposits. They're not a percent of total reserves, right? So to get the required reserves, you have to take a percent of deposits, not a percent of total reserves. Taking a percent of total reserves doesn't make much sense, because then how would a bank get away with holding 0 required reserves? They just hold 0 total reserves, right? So you gotta make sure that you calculate this as a percent of deposits. So this is essentially what banks do. Do banks like to hold excess reserves? Absolutely not. Banks hate excess reserves. Why? Because that's money that's not earning them interest. So what banks are going to try to do is they're going to try to turn these excess reserves into new loans, right? Because that's how they make money. That's what a bank's going to try to do. They're going to try to change this into new loans over time. So this is basically how banks work, right? This is basically how banks work. Now, one of the things you'll notice here about banks, banks are vulnerable. Any bank is going to have deposits that are much greater than total reserves. And that's essentially the problem of a bank run. A bank run is when all depositors try to pull their money out of the bank at the same time, often because they lose confidence in a bank. But if you look here at this, back at this example, what happens if all $10 million of these deposits try to get pulled out at once? There's no way the bank can pay off all those depositors. They only have $3 million. And those loans are already lent out. So here the bank could maybe sell their T-bills, but they're still not going to have enough money on the asset side to pay back all these depositors. And so that's the danger of a bank run. A bank run happens when depositors lose confidence in the bank. They worry that the bank could fail, and so they pull their money out. But of course, if everybody pulls their money out, what happens? The bank fails. It's a self-fulfilling problem. In many ways, bank runs are self-fulfilling crises, in the sense that if everybody believes there's going to be a bank run and the bank is going to fail, the bank fails. This is the reason for deposit insurance. Right? The FDIC, the Federal Deposit Insurance Corporation. And it's basically an insurance company where banks pay premiums. The premiums go into a fund. The fund is used to pay off depositors in the event of a bank failure. Of course, though, who's the ultimate backstop? Who's the ultimate insurer of our banking system? What would happen if the FDIC ran out of money? The government, right? Taxpayers. So taxpayers are the ultimate backup. And so this is the reason for government regulation. This is one of the reasons why banks are so closely regulated, is that there's a problem of moral hazard here. Banks are insured by the government. Banks are insured by the government. Need to make sure they don't engage in too much risky behavior. Now, banks are going to engage in risky behavior. That's the nature of banking, right? Banking in and of itself is risky. But there is undoubtedly a role of government here to make sure that, you know, a president of a bank doesn't just take depositors' money and go to Vegas and start playing craps with it, thinking, hey, if I win at craps, I keep all the money. And if I lose, I'm just going to stick the taxpayer with it, right? That's what we do not want happening, right? And so this is why there is a government need, a government priority for regulating bank behavior and making sure that they don't engage in too much risky behavior. And so I don't know if any of you have ever worked at a bank, but banks are amongst the most highly regulated institutions in the US economy, highly regulated. All sorts of regulations about what kind of activities banks can legally engage in and what kind of activities they cannot engage in. And the reason for this regulation is simply this, that banking is risky, and then there's a lot of these other issues related to moral hazard that could make banks even more risky. We want to make sure that banks are as safe as they can be, right? Because there's cost to society if they're not. And so that's the reason why we regulate banks, right? So banks have capital requirements, meaning that they have to hold a certain amount of capital to back all of their loans. They have to hold required reserves. They have loan safety standards. They have reporting standards. They run stress tests, right? They have all of this regulation to make sure that what they're doing is on the up and up, right? And so, you know, hopefully we can understand that better now, that we understand how banks work a little bit better. Now, for our purposes, we want to talk about the role that banks play in the money creation process. Because banks play a huge role in the money creation process. So I want to work through a simple example here. Okay, so in this simple example, let's assume that the Fed creates $100 in new money. We're going to talk about how exactly the Fed does this. But let's talk about this example where the Fed creates $100 in new money. And so the Fed goes back to the printing press. They print out a new $100 bill. And Jerome Powell, the chairman of the Fed, grabs that $100 bill and he gets in the golden Fed helicopter and he starts flying around. And he flies over Mount Vernon and he drops that $100 bill and it floats right to the middle of campus. okay? So that's new money that had never existed before, right? Let's also assume in our example that the reserve requirement ratio is 10%. And that all of the new money is deposited in a bank. Right? All the new money is deposited in a bank. So, so that $100 bills is sitting right there. Zach Stallman walking across campus, sees that $100 bill. He's like, sweet, new pair of sunglasses. All right. So he immediately jumps in his car, runs to the store, goes to the Walmart or wherever the hell he got those things, buys a new pair of sunglasses. What does Walmart do with that $100 at the end of the day? They deposit it in their bank account, right? And so if you think about what happens in Walmart's bank, what has the bank gotten? They've gotten $100 in new deposits. And they've gotten $100 in total reserves. Now, does the bank like this situation? No, right? Banks hate holding reserves because that's money that's not earning them any profit. The bank really wants to get rid of this. So how much of this $100 can the bank lend out? How much of this $100 can the bank lend out? 90, right, 90. Because remember, our reserve requirement ratio is 10% here. So we can really think about this as $90 in excess reserves and $10 as required reserves. So what does the bank do? Eventually, the bank would like to get rid of those $90 in excess reserves and create $90 in loans. Okay? So $90 in loans, the bank makes a loan. They make a loan to Colin, who is buying Super Bowl tickets for next year because he knows rightly that the Browns are going to the Super Bowl, and it's a good deal if you get them early. So Colin buys some tickets to the Super Bowl. You know, he buys it from Ticketmaster. Colin sends Ticketmaster the $90. What does Ticketmaster do with the money? They deposit it in another bank. This bank now has $90 of deposits and $90 in total reserves. Is this bank happy with its balance sheet? No, obviously not, right? This bank would like to loan this out. How much of this money can they lend out? How much of this money can they lend out? $81, right? Because this is essentially $81 in excess reserves, $9 in required reserves. Okay? So
Quick question. Oh,
yeah, I'm
no,
sorry.
quick question. Do they have the same reserve ratio then?
Yeah, so all the banks have the same required reserve ratio. And as we're going to talk about, this is set by the Fed. This is set by the Fed. Okay, so this $81 is going to get lent out. And let's say that it gets lent out to Cody because Cody read that Taylor Swift is actually re-recording all of her albums so that she can own the publishing rights to all of their albums, right? Because her first albums, her producer owns the publishing rights. I don't know. I kind of missed this whole story. So Taylor Swift, because she does not have enough money, is re-recording all of her albums. Cody's like, damn it, I'm getting all of those now. I need a loan. So he gets a loan. He immediately goes and down to the record store, buys all of her new albums. What does the record store do at the end of the day? They put that money in the bank. And that becomes $81 of new deposits. And once again, how much of this is required reserves? Well, $8.10 is going to be required reserves. And then the rest, $72.90, will be excess reserves. What will this bank do? They will eventually try to lend this out. And I'm not going to keep on going, right? Hopefully you guys all see the pattern here. Okay, what happened?
$100 just became much more than that.
$100 just became much more than that, right? The change in M1 is much bigger than the change in currency by the Fed. When the Fed changed the money supply, or when they changed currency, it led to a very big change in the money supply. This might look a little bit familiar to you. It's similar to what we talked about yesterday. It's a multiplier, right? This is essentially a money multiplier. New money leads to new deposits, which leads to new lending, which leads to new money, which leads to new deposits, which leads to new lending, on and on in a cycle, in a circle. That's a bad circle I just wrote up there, but hopefully you get it. There's a money multiplier. Just like we had a government spending multiplier yesterday or a tax multiplier, it's very much the same kind of idea. In fact, just like yesterday, using a little bit of algebra, you can show that the maximum money multiplier actually follows a simple formula. The maximum money multiplier is the change in M1 from a change in currency or a change in reserves. And I'll explain why it could be a change in reserves here in a moment. What is this maximum multiplier? It's 1 over the reserve requirement ratio. Okay, so in our example, here's our money market formula. What was the change in currency? $100. And what's the reserve requirement ratio? 0.1. So the ultimate change in the money supply will be $1,000. Once again, that would be, though, the maximum change, right? That would be the maximum change in the money supply. What do I mean by maximum change? What I mean by maximum change is it really goes back to the assumptions I made at the beginning of our example, that people would put every penny, they would deposit every penny that they had. What would the minimum multiplier look like? Anybody have any guesses? What would the minimum multiplier be?
No change.
Well, there still would be a change, but it wouldn't be any greater than the initial change by the Fed. In other words, the minimum multiplier would just be 1. So for instance, go back to that example. The $100 dropped on the ground. Zach picks it up, but instead of buying sunglasses, he just sticks it under his mattress. What's the change in the money supply? Well, the money supply has gone up by 100, but it's not going to go up by more than that because Zach didn't put it in the banking system where it would have that multiplier process. So the minimum multiplier would be 1, and the maximum multiplier would be given by that formula. And where is the money multiplier in the real world? Well, it's between those two, right? I mean, honestly, people don't put every single cent they have into the banking system, but they do put some of it, and that's going to lead to a multiplier process. So the key here is the Fed has a lot of power to change M1, right? The Fed's got a lot of power to change M1. And so this really leads us then to what we need to talk about now, which is the Federal Reserve. Okay. Because now that we've kind of established that the Fed has power and how they control the money supply, we need to figure out a little bit more about how the Fed actually works. Okay. What is the Fed? The Fed is a central bank. All right, what is a central bank? Well, a central bank is essentially designed to oversee the banking system and regulate the money supply. That's one definition, but honestly, the definition I prefer, because I actually think it's more illustrative of what a central bank does. A central bank is a bank for banks. A bank for banks. In other words, it's a place where banks can deposit money. It's a place where banks can get reserves. It's essentially where banks can get banking services. So central banking has a long history. Really the first, kind of official central bank was the Bank of England, right? Which was essentially a bank that increasingly became the bank for the government and a bank for other banks, providing loans and a place for other banks to make deposits. As we're going to see in modern economies, central banks take a number of different responsibilities. But in many ways, all of these really have to do with overseeing the banking system and making sure that banks have a place to get banking services, right? Now, there's a lot to be said here about our Federal Reserve. Our Federal Reserve is a very weird system. It just really is. And there's a good reason why our system is so unusual. And that is because central banks have always been a controversial topic in US history. Right? For those of you who remember a little bit from your US history classes, you might remember the big dust up about the first Bank of the United States and the second Bank of the United States, right? These were essentially early attempts to form a central bank in the United States, to have a bank for the government and to have a bank for the banking system. But while there's always been this kind of recognized need that we need some oversight of the banking system, there's also been this big skepticism about centralized banking in US history, right? So the skepticism that central banks somehow become the tool of big industrial interests, and as a result, they kind of essentially leverage the power of the rich to make them richer. And so, once again, for those of you who've seen the Hamilton musical or whatever, this was a huge debate in early US history as to whether the US should have a central bank like England had a Bank of England. And in fact, this was something that the framers of the Constitution punted on. There's nothing in the Constitution about a central bank. They basically left it for later. And so you had Federalists on one side like Alexander Hamilton, who's arguing, yes, we need a central bank. We need a big, powerful financial system with regulation. And then there were people on the other side like James Madison and Thomas Jefferson who were saying, no, we don't want centralized power. We want a very decentralized banking system with lots of little banks, right? But of course, the problem with lots of little banks is a lot of little banks means a lot of little banking crises. And that was pretty much true for much of US history, that without having a central bank, we regularly had banking crises because banks would get in trouble and there was nobody that they could borrow money from. There was nobody that would provide them financial services in the event of a crisis. And so what happened in the US was that in 1913, there was passed the Federal Reserve Act. And what the Federal Reserve Act did was it created part of today's modern Fed. But the original Federal Reserve looked much different than today's Fed. Basically, what the Federal Reserve Act of 1913 did was it created 12 regional Fed banks. Why in the world did it create 12 banks? To decentralize power. Okay, it goes right back to what I was talking about a minute ago, that there was a real fear of centralized power. And so to get this act to pass, the agreement was, well, if we're afraid of one big central bank, let's just have 12 central banks. And so these central banks still are part of the Federal Reserve System. If you look at these banks, you can see where they are. Okay, so each of these central banks essentially serve a different region of the country. First off, you notice a couple things about this map. The location of these regional banks don't make any sense to us today. They really reflect the US population back in 1913, right? So notice that there's only one central bank or one Federal Reserve Bank that's west of Dallas, right? Like look at that huge area that San Francisco has to take care of, right? But there's two Federal Reserve Banks in Missouri. There's one in St. Louis and one in Kansas City. That doesn't make much modern sense, but that was, in many ways, this map was drawn up to reflect the realities of 1913 and not the realities of today. You notice that here in Iowa, we're in the Chicago region. So all the banks that are in Iowa, their regional central bank is with Chicago. And so what do these regional banks do today? Well, today, these are the banks that you do business with. Today, these regional banks hold required reserves for banks. They lend to banks in a process that is called discount lending. We'll talk more about this in a minute. But if a bank needs a loan, they can go to the Federal Reserve to get what's called a discount loan. These regional banks do the regulation of the banks in their system. Okay. Now, when the Fed was first set up, these regional banks were essentially set up to be largely autonomous, essentially 12 different central banks. How did that work? Pretty much a disaster. Pretty much a disaster. Without getting into a detailed history of everything, what we found is that there was very little coordination between the central banks. What we found is that in certain regions of the country, there was a lot less sophistication about banking and monetary policy. And some of these banks really kind of were pathetic, right? I mean, they really did not have a good idea about how central banking should be run. And, you know, their Fed's role in the Great Depression was pretty disastrous. The Fed basically didn't do anything. And the one thing that they did do was they raised interest rates, which we now know to be exactly opposite of what you're supposed to do. But at the time, there was so little coordination, so much backward thinking about monetary policy that the Fed's performance during the Great Depression was pretty disastrous. And so what this led to was the 1934 Fed reform. This is part of the New Deal, in which the Federal Reserve was reformed. And two new components were added to the Federal Reserve. The first was the Federal Reserve Board of Governors. These are 7 governors with 14-year terms. The process here is very similar to getting on the Supreme Court. You're appointed by the president and you're confirmed by the Senate. Instead of having a lifetime appointment, though, you only have a 14-year appointment. One is appointed as chair for only a 4-year term, and that is currently Jerome Powell, who was appointed by President Trump. The previous chairman of the Fed was Janet Yellen, who's now Treasury Secretary under Joe Biden. Okay. It is really with this Board of Governors that most of the power is today. It is the Board of Governors who essentially run the Federal Reserve. Many of the bigger, more executive functions have been moved from the regional banks up to the Board of Governors. I don't know how in the world I spent centralized. You guys know what I mean. right? It's centralized power. And so as opposed to having 12 different power centers in the Fed, today there's much more clearly one power center. So for those of you who have ever been to DC and you've ever gone to the Supreme Court, the Federal Reserve is right across the street from the Supreme Court. They're really kind of facing each other. And so that's really where power in the Federal Reserve System is centralized today. In addition to the Board of Governors, though, there's another group that's been created called the Federal Open Market Committee. This is a group within the Fed of the 7 governors, the New York Fed president, and 4 of the other 11 presidents. On a rotating basis. And it's this group that actually sets monetary policy. Okay? This is the group within the Federal Reserve that actually sets monetary policy. This is the decision-making group. This is the decision-making group. But very importantly, who's the majority on this committee? The 7 governors, right? There's 12 people on this committee, 7 of them are governors. So the governors are still the majority power on this committee. Okay? So when the Board of Governors get together to meet, that's news, right? Because basically what the Fed is setting is what monetary policy is going to be for the next 6 weeks. And as we move in, finishing up our lecture this morning and then tomorrow, we're going to be talking about, well, what exactly does the Federal Open Market Committee talk about? What do they consider when they set monetary policy? And what does setting monetary policy really mean, right? Before we talk, though, about monetary policy, I want to be clear here that central banks have many responsibilities. Okay, we're going to talk about monetary policy here in a minute, but central banks do a number of important things. The first one, as I mentioned before, central banks serve as a bank for banks. They hold required reserves. They make discount loans to banks. Also, the Fed clears interbank payments. What does this mean? Well, this is actually a really important function. If let's say your roommate is from California and he writes you a check from a California bank. In the old days, what would have to happen is that check would actually have to go to California. And then that money would actually have to be wired back to your bank. That could take days, weeks, who knows how long. Nowadays, what happens when something like that happens? If your roommate writes you a check from a California bank and you take the bank to Hills Bank, what does Hills do? It sends it to Chicago. And what will the Chicago Fed do? The Chicago Fed will take money out of the California bank, put it in Hills Bank, and process, right? This nowadays takes minutes to clear checks as opposed to days or sometimes weeks. And so this has made payment systems much, much more efficient. And that of course, is one of the big reasons we have central banks, is that they provide all of these financial services that banks need. They also are the key to bank regulation. Increasingly, after the global financial crisis, there was a big bank reform act called the Frank-Dodd Financial Reform Act. And one of the purposes of this act was to rethink bank regulation, because before 2010, quite honestly, bank regulation in the US was a mess. It was an overlapping system of different regulators. Any one bank could be regulated by the state. They could be, depending if they were chartered nationally, depending upon how they were chartered, you could have 3 or 4 different regulators. One of the things that the Frank-Dodd Financial Reform Act did is it made the Fed the principal regulator. Of the entire financial system. Okay. So what this means is that the Fed can do a whole bunch of stuff, like set the required reserve ratio. Set loan safety standards. Set information requirements. Assess bank risk. Et cetera, et cetera, et cetera. It is in this regulation process that you can think about the Fed as being the lender of last resort. And what does that mean? If a bank can't get a loan from any place else, they can always go to the Fed, right? If a bank can't get a loan from any place else, they can always go to the Fed. That is one of the roles of a central bank, is to be the lender of last resort. Now, let's be clear what this means though. Lender of last resort does not mean the Fed has to give a bank a loan. The Fed will only lend if a bank is fundamentally sound. In other words, if the bank is in bad shape, the Fed is not going to lend to you. If that's not the case, the bank will fail and the FDIC takes over. So it is not the Fed's job to bail out bad banks. It is not the Fed's job to bail out bad banks. The Fed is there to be a lender of last resort if it's a basically sound bank that just has some short-term problems. But if the if the Fed makes the judgment that this bank is fundamentally unstable, it's going to let it fail. So I distinctly remember when I was a kid, I grew up in a small town in Ohio, and growing up in the 1980s, right? I hate to say how old that tells you I am, but in the 1980s, we had in the US the savings and loan crisis, which was really related to that buildup of inflation during the 1970s, right? So we talked about how when inflation went up, what did that do? That created huge losses for lenders, particularly savings and loans, which were banks that specialized in home mortgages. And so if you were a bank and you made a mortgage in the early 70s, you lost your shirt. And a lot of those banks went bankrupt, including one of the small banks in my hometown. And I can just distinctly remember the bank was there one day, and then the next day there was a big sign that said closed. And what happened is the Federal Deposit Insurance Corporation came in, they paid off the depositors, they sold the loans, they sold the building. That thing was out of business in about a week, right? And, that's what happens, right? That's what happens. And, the FDIC got the money that it could for the bank. And then if there was a shortfall, well, that shortfall was covered by, the funds in its reserve or ultimately taxpayers, right? And in the case of the savings and loan crisis that took place in the 1980s, taxpayers did have to fund some of it because there was not enough money in the FDIC fund to pay for it. So taxpayers ended up paying for some of this. So anyway, that's an important function of the Fed. The third function of the Fed is the bank of the US Treasury. It's the bank of the federal government. So who also holds deposits at the Fed? Not just banks, but the federal government does. So for those of you who got a stimulus check, or you got a bank refund, a tax refund, where did that refund come from? The Fed, right? The Fed actually cuts those checks. So the Fed serves as a bank of the US Treasury. And this is, of course, one of the reasons why Alexander Hamilton and many of those Federalists argued that we needed a central bank, is that the government needs a bank, right? The government has a lot of needs for banking services. And so having a Fed is an important way, to be able to provide these services. And then the fourth is to set monetary policy. And this, of course, is the one, maybe the most important one, the one that we're going to talk about the most. But we're kind of close to the end of our time, so we really can't get into this. But what I think we'll do this afternoon is maybe I would like to take 20 minutes or a half an hour. Let me think about it, but maybe just talk a little bit more about some new material here in chapter 14. But I won't talk very long. We won't cover much new material this afternoon. And then after that, we'll save a little bit of time for questions that you might have about the quiz. And then we'll take the quiz number 4 this afternoon, okay? And remember, quiz number 4 is on, it's on chapter 12, which is aggregate demand, aggregate supply, and it's on chapter 13, which is fiscal policy, okay? All right. So any questions before I let you run the lunch? Okay, thank you, everybody. We will see you back here at 12:30.